So are you curious about tax issues to prioritize in 2026? Stay tuned for our top 3. Today, we are talking about 3 of our top priorities in tax issues to tackle and be prioritizing as we move into 2026. Tax planning isn't something that you just do in April, right? It's an ongoing strategy. It can significantly impact your after-tax returns and long-term financial situations and outcomes. Over the next few minutes, we just want to walk you through 3 areas where we think smart planning can make a real difference. Priority 1, capital gains and loss planning. Obviously, that's huge. It's really about being intentional about when it is that you take your investments, right? When you actually take the gains, or do you take losses, and those sorts of things. It's actually one of the only times that you'd ever hear us talk about timing the market, is because we really want to take a look and say what makes the most sense. So how and when you realize your investment gains matters just as much as how much you can take. It's important to realize long-term capital gains are taxed at a different rate than short-term gains. Long-term gains are anything over a year and a day that you've held a position, and those are going to be taxed at 3 separate static rates, so either 0%, 15%, or 20%, whereas short-term gains are actually taxed at ordinary income rates, right, which is then going to be typically higher than what those long-term pieces are. So really, without planning, it's easy to trigger unnecessary taxes.
It's a good time of the year at the beginning of the year to kind of know ahead of time what kind of capital losses you've carried forward and taken it into the new year, and also what other assets outside of investments that you might be selling and experiencing a gain on that we can use as an offset. So there's a lot that goes into it. It's a really a broad area, and this is a good time to just kind of be looking ahead.
Mm-hmm. No, and that's a great point in a lot of different areas, right? Like, it's really a 360-degree view that we need to take, because there are other income streams. Maybe you are realizing some sort of capital event, and that can really, really impact what is going on there. So one of the most important tools or useful tools is tax loss harvesting, and that's really when you realize losses in the current day and can offset the gains that you might be taking later in the year, or you can move those forward year in and year out. And so one of the things that we like to do is we like to look and say, hey, moving forward, do we have a tax budget? How is it that we're approaching 2026, 2027, 2028, et cetera, so that we know this is appropriate, and we can give you a sense of what is going to be the pain of the tax at that point, and is it acceptable given your longer term outcomes?
And when we do tax loss harvesting, it's not that we think the investment is bad. It's just that tax loss has so much value. Correct. So you're not going to stay out of the market. We're creating a loss, and then we're getting you right back into the market. So it's just something to remember, that this is a loss that has a lot of value. And so I like to just add that.
No, that's a really solid point. See, so wise. Priority 2 really is talking about retirement contributions and distributions. Moving forward, we see a lot of things in terms of changes towards retirement accounts that are going on, and really this is an area where taxes can catch investors off guard. Especially when you're taking some of those distributions, or you're forced to take a distribution, right? 2026 contribution limits continue to raise, and that means there's more opportunity to save in tax-advantaged accounts. But at the same time, there's some recent rule changes that are pushing some higher income investors towards a different strategy. This year, for a standard contribution, total contribution for the year in a 401k, $24,500. And then after 50, you've got a catch-up provision, which is $8,000, but that's now got to be exclusively into a Roth contribution. And then there's an additional piece now where from age 60 to 63, you have additional catch-up, right? So that would be $11,250. So there's a lot of opportunity to continue to do that. But again, with the change in terms of contributing to a Roth, or being forced to contribute to a Roth, and realizing those taxes right now based on your income, that changes things a lot too.
It does change things, but I always think to myself a little big picture, in that don't stop saving in retirement because of the tax. Just continue to save. You will never regret it. We're in it for the long game.
So that's the contribution side. On the distribution side, required minimum distributions they can obviously significantly increase the taxation of any kind of income that you take in terms of retirement. And that's important to realize. Like, we like to have people into 3 different tax buckets, right? We want to have a tax deferred bucket where everything you take is ordinary income. A taxable bucket where you're really just paying on the gains, and hopefully those are long-term capital gains, or an after-tax bucket, which is 0. So that allows us as planners to go ahead and say, again, with a tax budget, here's how we mitigate some of your taxable events. Because you imagine someone who's got like a $1.5 million tax-deferred account, and that's all they have, and they have a large income need or cash flow need, and all of a sudden they're just getting a tax in ordinary income. So it's also important to realize when you're taking those distributions, that can impact your Medicare, right? As well as your Medicare premiums, as well as then your Social Security benefits.
Mm-hmm. And the upside, kind of positive to that is, if you are retired and your income is fairly low, maybe you're before the required minimum distribution, what a nice time to either take a little more from those IRAs and a lower income, try to lower that required minimum distribution down the road, or do Roth conversions.
I mean, you and I love Roth conversions at the appropriate time. So when you look and you say, hey, are there lower income years? Maybe there is a point where you can say, we're going to go ahead and we're going to convert that tax deferred dollars, pay the taxes now, but pay it up until, like, max out one bracket. Mm-hmm. So it's converting strategically, right? It's not just, hey, I've heard about Roth conversions, we could do that. Well, let's take a look at everything else. So third priority, estate gifting and deduction planning, which you kind of indicated. Exemptions may change in the coming year, which could expose some more wealth to some issues without proper planning. Things like donor advised funds, where we're grouping your gifting strategy together, so that mitigates your tax for the year. It also then helps your causes. Qualified charitable distributions, and then strategic gifting. A lot of people don't really think about, there's this $19,000 limit or exemption limit on gifting to any individual, from any individual. And so even though that's not a huge amount, it's enough where over a period of time you can start to mitigate some of the taxable effects on your estate later on, because you're giving those dollars away. And it's really fun to watch the people that you're giving to enjoy the funds, or enjoy them together. That's a pretty powerful thing. But all of this is best done proactively, right? And so whether that's just the beginning of the tax year, or it's at this point looking forward to your legacy. I've never met anyone who says they didn't wish they started earlier, and today is the earliest we get. So let's start now and look proactively. For me, as we approach 2026, most important takeaway, tax planning works best when it's integrated and it's forward-looking and it's hyper-personalized. So there's that piece too. So let's review your tax strategy now. And then the other thing that's always important too is, we like modeled scenarios, not guesses. So again, that's where we're going to lean in hard, and we're going to say this is going to be the overall long-term process of what we're doing.
There's a lot of noise out there too, so just be aware of what you're hearing on social media, all the, I'm missing out on this great tax strategy and what have you, but just know that a lot of those strategies may not even apply to you, so you maybe aren't missing out. You're going to hear a lot of noise and a lot of buzz, and just make sure you're talking to your tax professional and hearing this story straight. Lots of tax things going on.
Lots of taxes. Taxes are never fun, but they can certainly be managed. So that's that. All right, well, thanks for listening.